A $35,000 car is not a $35,000 decision when the finance desk turns it into an 84-month loan. At 6.9%, about $36,500 financed can become roughly $46,124 paid back. That can leave you still making payments after the warranty gets thin, the tires are due, and the car may be worth less than you owe. By the end, you will know how to compare the monthly payment, total interest, payoff date, depreciation gap, and exit risk before one calm number traps 7 years of your paycheck. Start with the number your brain wants to believe, $35,000. It feels like the price, but the loan cares about the amount financed after tax, title, registration, dock fees, destination charges, dealer add-ons, and the little protection package that appears when everyone is tired. So a $35,000 car can become about $36,500 financed before the first payment exists. Then the conversation changes from "what does this car cost" to "can we make the payment work?" At 6.9% for 84 months, that $36,500 loan is roughly $549 a month. Not fun, not cheap, but survivable. A household can look at $549 and start rearranging groceries, insurance, gas, subscriptions, and maybe one dinner out until the deal seems barely possible. But 84 payments later, the total is around $46,124. So the honest sentence is not, "your payment is $549. The honest sentence is, this $35,000 car can become a $46,124 commitment if you drag the loan across 7 years. The car did not get cheaper. The calendar got longer. That is why the finance desk is so powerful. You already picked the car. You imagined the commute. You liked the quiet cabin and the relief of replacing the old car that keeps blinking warning lights like it wants to resign. Then the payment appears. The 48-month option looks rude. The 60-month option makes your budget tense. The 72-month option feels like a compromise. Then 84 months appears, and suddenly the payment relaxes. But the price did not relax. The pain just moved into future months. It's like getting a huge restaurant bill and hearing, "Good news, you can pay for this dinner until 2033. The dinner is not cheaper. Interest is the rent you pay to use someone else's money. APR, or annual percentage rate, is the price tag on that borrowed money. Plain English, the lender charges you for every month the balance is still alive. Stretch a car loan from 60 months to 84 months, and you give the loan 24 extra months to charge rent. At 6.9%, the $36,500 loan costs about $9,624 in interest over 84 months, versus about $6,761 over 60 months. The longer loan buys about $172 of monthly relief, but adds about $2,863 in interest and keeps the payment alive 2 extra years. That $172 is real. For many households, it is groceries, gas, medicine, school lunches, or a small emergency cushion. That is why the 7-year loan can feel like oxygen instead of a trap. Now make it human. Jordan needs a car for a 40-minute commute because the old one has started doing the expensive dashboard light routine. Jordan is not trying to flex. Jordan is trying to get to work without calling a tow truck on a Tuesday morning. Rent is up, insurance is up, food is up. Maybe there is daycare, student loans, or a credit card balance from one bad month. The 60-month payment feels like it could shove the whole budget sideways. The 84-month payment feels survivable. So at the desk, the question becomes, can you handle $549? That sounds practical. It sounds like budgeting, but it is too small. The better question is, what does this car cost after 7 years of interest, depreciation, insurance, repairs, tires, registration, and one normal life change? Cars are not just loans. Cars are aging machines. Depreciation means the car becomes worth less over time because it gets older, gains miles, wears down, and becomes less attractive to the next buyer. The payment goes down slowly and politely. The car value can fall quickly and without asking permission. A $43,899 loan at 6.9% for 84 months is roughly $660 a month and about $11,575 in interest. The same loan over 60 months is about $867 a month and about $8,132 in interest. The longer loan saves about $207 a month, but costs roughly $3,443 more in interest and keeps the payment alive 2 extra years. Sometimes that may still be a calculated compromise. If the car is reliable, the rate is reasonable, and the payment protects your emergency fund, a longer term is not automatically stupid. The problem is that 84 months can make an expensive car look reasonable before you have seen the full cost. Meanwhile, the car keeps aging while the loan keeps breathing. In 2026, the car is new. In 2028, tires may be due and insurance may be higher. In 2029, the car is just your car and the balance is still there. In 2030 and 2031, warranty coverage may be gone or shrinking. In 2032 and 2033, you could be making a new car size payment on a car old enough to want old car maintenance. That is the mismatch people miss. A 7-year loan can pair new car payments with old car problems. This is where negative equity enters the chat, wearing a dealer polo and pretending everything is fine. Negative equity means you owe more on the car than the car is worth. If you owe $30,000 and the car is worth $24,000, you do not have a $24,000 asset. You have a $6,000 exit problem with wheels. Bring Jordan back. After 1 year on that $43,899 loan, Jordan may still owe around $38,845. After 2 years, around $33,432. After 3 years, around $27,632. If the car is worth $22,000, Jordan is not just tired of the payment, Jordan is stuck behind it. Then life changes. Maybe the commute changes. Maybe a second kid arrives. Maybe insurance jumps. Maybe the car needs repairs that feel ridiculous for something still costing $660 a month. Jordan tries to trade it in, and the dealer says, very calmly, "We can roll that negative equity into the next loan." That sounds helpful, but it means the old car leaves and part of the old car follows Jordan into the next payment. That is how the loop starts. The 84-month loan first appears as monthly relief, then extra interest, then a slow balance, then a depreciation gap, then an exit fee when life changes before the loan is done. Credit scores make the same structure more uneven. Excellent credit may mean a new car rate in the mid-single digits. A thin or damaged credit file may mean high single digits, low teens, or worse. That is not a moral judgment, but if the APR rises, more of each payment goes to interest before the balance falls. And this is not a vibes-only complaint. Experian's Q4 2025 report put the average new vehicle loan amount at $43,582, the average payment at $767, and the average rate at 6.37%. Edmunds' Q1 2026 analysis reported $43,899 financed, a $773 average payment, a 6.9% APR, and 84-month or longer loans at 22.9% of financed new car purchases. Apparently, buying the car is only the first subscription. The loan term is the easy dial to twist. If the payment is too high, stretch the loan. If it is still too high, stretch it more. 7-year car loans have moved from, "Wait, people do that?" to, "Here's another normal option on the financing screen." When 84 months looks normal, the buyer can start to think the problem is their budget, not the price of the car, the cost of borrowing, or the structure of the deal. Dealers can protect the selling price. Lenders can collect interest for longer. Buyers get trained to ask the smallest possible question, "Can I afford the monthly?" That question is not wrong, it's just incomplete. So shop backwards from the real cost. Before you talk monthly payment, write down 5 numbers: out the door price, amount financed, APR, total interest, and payoff date. Out the door price is the full price to leave with the car. Amount financed is the loan balance after down payment and fees. APR is the price of borrowing. Total interest is the extra amount you pay because you borrowed. Payoff date is the year the car finally stops billing you. Compare the same vehicle at 48, 60, 72, and 84 months. For the $36,500 example at 6.9%, the payment moves from about $872 to $721 to $621 to $549 as the term gets longer, while interest rises from about $5,373 to $6,661 to $8,179 to $9,624. Notice the pattern. Every friendlier payment pushes the payoff date farther into a version of your life you have not met yet. Now add the column most buyers never put on the page, likely resale value. Ask what the car might realistically be worth after year 3, year 5, and year 7. Then compare that value with your loan balance at the same points. If the balance is likely to stay above the car's value for a long time, you are not just buying transportation, you are buying reduced flexibility. Then lower the price before you stretch the term. What if you remove a $1,295 protection package? What if you skip a $900 appearance add-on? What if you choose the lower trim that is $2,500 cheaper but still has the safety features you need? Those changes reduce the amount financed. Reducing the amount financed helps every term. Stretching the term only hides the pressure. Before you sign, get pre-approved. A bank or credit union can give you a benchmark before the dealership's payment menu takes over. Bring that offer with the rate, term, payment, and total interest visible. When someone shows you the friendly monthly number, ask for out-the-door price, amount financed, APR, total interest, payoff date, 60-month payment, add-on costs, year 3 balance, and likely resale value. Monthly add-ons deserve suspicion because they are designed to sound tiny. A warranty becomes $27 a month. Gap coverage becomes $12. A protection package becomes $19. But the loan experiences them as more principal, more interest, and a higher balance. The test should be, would I still buy this if I had to pay cash? And if the warranty is 3 years but the loan is 7 years, you may spend 4 years paying while more repair risk belongs to you. Choose the shortest term that fits without draining emergency savings, skipping bills, or pushing normal life onto credit cards. If the shorter loan would create credit card balances at 20 or 25%, it may just move the damage to a more expensive account. But if 84 months is the only version that fits because the vehicle price is too high, treat that as a warning light. Stress test the APR too. Ask what happens if your actual APR is closer to 9%, 13%, or 16%. Then price the full monthly footprint. If the payment is $549 and insurance adds $180, you are already at $729 before fuel, maintenance, registration, tires, repairs, or the first mysterious noise. Finally, decide your exit plan before you sign. If you truly plan to keep the car for 10 years, maintain it well, and pay it off faster when possible, a longer loan may be a calculated compromise. But if you usually trade cars every 3 or 4 years, if your job is unstable, if your family needs might change, or if the vehicle is already stretching the budget, an 84-month loan can turn flexibility into a luxury. The $549 payment tells you whether the car can squeeze into this month. The $46,124 total tells you what it can become over 7 years. The interest, depreciation, warranty timeline, insurance, repairs, and payoff date tell you how far into your future this decision reaches. So before you ask, can I afford the payment, ask the better question, what is the full deal I am agreeing to? That question forces the hidden costs into daylight. Interest, years, depreciation, trade-in risk, warranty mismatch, insurance, repairs, payoff date, and the life you are locking that car into. Your car is supposed to help you get to work, take care of people, and move through your life with more freedom. It is not supposed to rent space in your paycheck for 7 years because one number looked calmer at the finance desk. So the next time you shop, compare the same loan at 60, 72, and 84 months. Then circle total interest, payoff date, likely resale value, and the car age when the final payment is due. If the lower payment still makes sense after you see the full cost, then at least it is a choice. But if stretching the loan is the only thing making the car feel affordable, listen to that. Your goal is not just to get approved. Your goal is to still have room to breathe after the car is in the driveway. The payment tells you whether the car fits this month. The term tells you whether it fits your life. And the total cost tells you whether that affordable payment is actually buying transportation or selling pieces of your future back to you 1 month at a time.